Hi, everyone. It's Kali Persall, editor of Institutional Investing and Infrastructure, here with Eric Purington, investment director and portfolio manager at Aberdeen Investments. And we're going to just talk about the opportunity set for private infrastructure investments in the current market environment. Eric, would you just mind kicking us off with a few words about yourself and your role at the firm, please?
Yeah, sure. I focus on middle market infrastructure investments, primarily on behalf of the New York Stock Exchange publicly traded closed-end fund, Aberdeen Global Infrastructure Income Fund. I've been in the infrastructure investment space on the private side for almost 15 years now, and I really love to talk about it. So I'm glad we get to talk today.
That's great. I mean, it's a perfect opportunity, and there's certainly a lot going on in the market right now. So, speaking of that, are you seeing private infrastructure investments being affected by market volatility and tariffs? And I know your program focuses on middle market infrastructure investing. As just a follow-up question, does anything sort of change when considering middle market investments?
Yeah, great question. I think it's something I spend a lot of time on thinking about every day. And yes, I think in short, we are impacted by volatility and tariffs. The entire economy is impacted by volatility and tariffs. But I think it's worth just thinking about infrastructure on a holistic basis. And one of the key tenets of infrastructure investing is stability through times of stress. Certainly in my career, since I started in 2010, we dealt with kind of the follow-on knock-on effects to the great financial crisis, and then later changes of administration, COVID, interest rates, and infrastructure as an asset class persevered through all of that. And I do expect that to be the case here. So to answer your question, are assets being impacted? I think it's primarily those assets that are in this short window where they're buying a lot of stuff and putting it into the ground. Typically assets that are somehow in the middle of construction, particularly on the renewable side. We've seen that in some impacts from the offshore wind side and also on onshore, both solar and wind in the US. But ultimately, I think infrastructure, as I mentioned, as an asset class, is resilient and has the ability to withstand these. Just as an example, one of our portfolio companies is a midstream, a gas storage asset that we are building an exciting second phase of the asset right now. So we are, in this case, we are putting money into CapEx right now. And ultimately, the answer comes down to pricing power. Do we have it with our customers? And as an essential infrastructure provider, the answer is yes. And in a lot of cases, we have been able to pass on some of these tariff impacted costs to our customers. You mentioned middle market investments in particular. And what I love about the middle market space, which differs a little bit from working in listed infrastructure and in the large cap space, is we can really, pinpoint our opportunity set. Typically every single company in the middle market space that we invest in, and every single asset that we invest in, has a business model that can be summarized in one sentence, right? It's typically kind of a limited market, a limited opportunity set with a very concentrated kind of management team. And in that opportunity has allowed, I think, us and all other middle market investors to be better situated through this tariff uncertainty than perhaps some of the global investors out there.
Absolutely. Thank you for speaking about the middle market. We've been hearing a lot of, in terms of interest and even competition going into that space because of the interest that's
Mhm.
there right now. So what do you think is making middle market private infrastructure investments particularly attractive in the current environment?
That's a great question, Callie, and one that I get a lot from some of our clients and other market participants. And it actually, in my view, has a very simple answer. It's simply supply and demand. And we'll start with the demand side. The demand side of the supply and demand question is the ocean of capital that's been raised by large cap infrastructure funds over the last decade, but in particular over the last five years. McKinsey just released a study just a couple weeks ago showing that large cap infrastructure funds have over $400 billion of dry powder. That's money that they need to deploy. And that doesn't even take into account the billions of dollars that strategic investors in the space, utilities, midstream companies, are looking to deploy as well. We've seen huge amounts of M&A, particularly in the midstream space over the last year, and I think that trend will continue. So when you put these 2 points together, there's a significant amount of infrastructure focused, large cap, dry powder, and significant demand from strategic investors in the space. What that means is when we have opportunities for those companies on the mid cap side, there will be significant demand, and we're actually seeing that. We're seeing that in valuations for our exits in the mid cap space, in the small cap space, and we will continue to see that in the years to come. Just as kind of a point, the last 3 exits from our portfolio all went to large cap infrastructure funds or portfolio companies, and that's a trend that I expect to continue. This supply demand trend that I mentioned, I think it's worth noting, is completely independent from interest rates, from administration changes, from tariffs, even from markets in general. I would say that this is capital that will be deployed from large cap infrastructure funds, usually to acquire successful mid cap funds and assets like the ones that we have in our portfolio today. So very excited about this dynamic in the years to come.
Yeah, great. So you mentioned the significant amount of dry powder that's available. Looking at international markets outside of the United States, what can they sort of offer investors, and which ones are you guys looking at right now that you're thinking are the most attractive?
I think one that comes to mind, just to get right to the point here, is Japan. It's a challenging market to invest in, but one that I worked in for almost 8 years, focused on the renewable energy space. Here's just a fact, a fact from today, that if you look at where Japanese utilities on the listed infrastructure side are trading, they're as of today, they're trading at roughly half the valuation of U.S. utilities. Now, there's a lot of reasons for that, but one of them is that the entire market is potentially undervalued. And I think that is an opportunity for private market investors. Now, it's a tricky opportunity for private market investors, as anyone who's invested in Japan can testify to. But one action that we've taken recently is an investment in a global IPP with a significant overlap in terms of operational and development assets in Japan. We're really excited about that opportunity, and we're really excited about the Japanese market and look forward to kind of participating there in the years ahead.